So we have a full house today, which is fantastic. Thank you very much for taking some time out of your busy schedules. We usually try to run these roadshows a little bit later on in the year so we don't compete with a lot of the other fund managers. So thanks very much for coming. So this is our annual investment briefing, 2017, Consumption and Technology Driving the Asian Century. So my name is Jonathan Wu. I'm one of the co-founders, executive director, and chief investment specialist of the group, which many of you I've known for the last 15 years. And thank you for your support for our business. So the themes of disruption and technology is something that has been presented to you for the last 18 months or so, and how that's shaping a lot of the traditional business models that we're seeing across the globe, and how that's making some businesses effectively become irrelevant and allowing other businesses to thrive in what is a very much smartphone and cloud-based environment. Now, in the last 12 months, a lot of the news feeds that we have seen has taken a lot of light out of China and out of Asia, and we're focusing on the US president, which for better or for worse. And in the last couple of months, obviously North Korea has come into the fold in terms of news feeds. Now, a lot of advisors have come and asked me and said, Jonathan, what happens if North Korea does something silly? And me and Renee share a slightly different view. As an advisor, if North Korea fires a missile or multiple missiles that hits across the globe, you probably won't be doing your next client's investment review. That's the reality and most practical point. Renee will share her view, and we actually have a slide on North Korea and how we actually see that situation from a practical perspective in the next 12 months. So that's our standard disclaimer. Now, something I haven't done ever in a presentation is actually recommend everyone to read a book. And this came up on my radar about a month ago and at the Portfolio Construction Forum. So you may have heard of an organization called China Matters that's run by a Swedish lady named Linda Jacobson, who's spent the last 22 years focusing on China policy, speaks very fluent Mandarin, and spent 22 years of her life in China. Now, why this book is important is that this was published in February this year. And what this book actually looks at is how Australia's relationship is going to develop with China over time. Now, those of you that have known me for long enough know that I'm not some communist party, bagger or praiser. I look at things at a very balanced level, and I have a lot of things to criticize about the way the Chinese run things, as well as a lot of positive things that the Chinese government does to both ensure prosperity occurs over the long term for their population. This book is a bit of a wake-up call for how Australians need to look at China and how to understand how we can be better placed over the next couple of decades as to how that whole Asian and China-centric century plays out. So something that I recommend you to read. It's available on iBooks and also in hard copy. I'm about halfway through the book. It's very, very good. At Portfolio Construction, another thing that I learned was every fund manager that ever presents to you, you need to ask them 3 questions. Now, those of you that haven't come to our presentations before, I'm actually a financial advisor today. We manage about $300 million on behalf of our clients based out of Sydney. And these are 3 questions that I've learned to ask every single fund manager when they come to pitch to you. 1, what are the inefficiencies in the market in which you operate? Number 2, how does your process exploit these inefficiencies? So what's so special about your investment process that becomes a byproduct of returns? And finally, why do you expect that they will continue to exist in the future? At the end of Renee's presentation on Asian equities and Greater China equities, she'll explain and answer those 3 questions for you. And later on, when I talk about fixed income, I'll also answer those 3 questions for you. So the agenda today is give you a quick corporate update. Renee will jump straight into Asian equities and give you a couple of the investment themes of what we're looking at today, so stories you can take back to your clients. And thirdly, a portfolio update that looks at both the China fund and the Asia fund. So some of you may have realized that Alan is no longer with us. Alan has gone to spend more time with his family. Renee has now taken over the Premium China portfolio, which she was actually looking after 5 years ago before Alan came on the scene. and she's always been the oversight deputy CIO for the fund. So it was very natural that from a transition perspective and also a longevity perspective that we have Renee come back into the fold to run the Premium Asia Fund. I'll come back to talk about Asian fixed income, how we derive yield for your clients, and look at it from an advisor's perspective as opposed to just from a fund manager's perspective. So for a corporate update, a lot of you know Value Partners. We have a very, very strong heritage of 24 years. We now manage more than 16 billion USD, which is split around 4 billion in fixed income, making us the largest Asian fixed income manager in the world. That's very important for my later conversation with you. Listed on the Hong Kong Stock Exchange, we've won more than 140 awards. We have 66 investment professionals split across fixed income and equities. We now have a new office in London, which also expands our capability to look at all the markets around the world 24 hours per day. And they're also launching a whole range of alternatives funds, which we're not bringing to Australia. We're just focused on active alpha equities and also active alpha fixed income. So our investment philosophy is value, and value in the current environment is very important. When we split out a lot of the developed market equity growth stocks, they've run very, very ahead of steam. So the value style is something we're going to talk about later on today. And our key competitive advantage is the simple fact that we do 2,500 company visits per annum in order to find the best ideas for you and your clients in a market which, even 15 years on from when we launched our business, is still an under-researched and under-penetrated market. This is our senior investment team from senior fund manager upwards. The people that are highlighted in red, Renee runs our Premium Asia, Premium China portfolios, Gordon runs our fixed income, and Michelle runs our property securities fund, which is something that we're not talking about today. This is our best-in-class track records. This is something that we're proud of. This is our heritage. We show this chart to you year in, year out. 24 years track record, 15% per annum net of all fees, against a benchmark of the Hang Seng, which has only done 8, and the MSCI China, which some of you may have considered investing into index, has done 1.1% per annum for 24 years, with a volatility level higher than 30% per annum. So what we're trying to prove to you, and you see it in the China fund figures, we are showing higher alpha than the market and lower volatility, which is what we've promised to you since day one. So I'm going to pass on to Renee. Renee is the Deputy CIO of the group. This is the first time she's joined us on our roadshows, and she's going to take you through the market review, our investment themes, as well as our portfolio. So please welcome Renee.
Good afternoon, ladies and gentlemen. Thank you for your time today to join our presentation. So my name is Renee Hong, and I'm the Deputy CIO of Value Partners. And for those who I haven't met before, just to give you a brief background, I was born and raised in Hong Kong, and I went to UCLA in the United States for my bachelor's degree, and then I came back to Value Partners as my first job to join as an analyst. So I've been covering the Hong Kong, China, and Asia ex-Japan region for the past 19 years. And here I am to talk to you about how we view our markets in Asia, ex-Japan, and how our portfolios are positioning to benefit the future growth in this area. So I will do a quick review here to talk about how come Asia ex-Japan has been so strong in terms of stock market performances. As you can see from this slide, basically since 2010, it's the first time that Asia ex-Japan experienced an earnings upward revision by the analyst. In the past few years, it was constant disappointment of downgrades and downgrades. And out of this upgrades in earnings growth and also the earnings growth for the region, Korea actually contribute about half of them, with China coming the second, and Taiwan and Hong Kong. We have slides a little bit later to talk about these countries individually. And again, in aggregate, I want to highlight to you all, for the Asia ex-Japan companies, the financial matrix is going on a very good shape. You can see here the EBITDA margin of these companies are on the rise since 2012. The operating cash flow is also stronger than before. And here highlights the export recovery in the various regions. Asia ex-Japan leads in terms of growth rate. So maybe I can dive a little bit into each individual country, and then to talk about the outlook and what are the key points we are seeing. First, I will start with China. In this chart, I would like to highlight to you the GDP growth rate for the next 5 to 10 years, according to the policies from the government, is going to be about 6% or so, or close to 6% per annum. It's a notch lower than past 10 years ago. I'm sure for all of you who have been covering China will be well aware of this fact, because it's not healthy for China to undergo such a high growth phase. So Chinese government have to carry out various reforms to make the economy to grow stronger and in a more sustainable basis. And there are some timelines in 2017 that is important for China. We are now in September, so the next upcoming one, very important one, they just announced the date, which is the 18th of October, which is China's 19th plenum meeting that will take place in Beijing. So this is very important because in China, every 10 years, they have a major leadership change. 5 years ago, President Xi came into office, and this time is a natural extension, and always, usually he will be extended for another 5 years. At the beginning of this year, some of the people may be questioning what would be the situation for the next 5 years. But now it's very clear to us that President Xi has a very strong grip in power, and all the reforms, policies that he has been carrying out in the past 5 years will be sustainably carrying out going forward in the next 5 years. What is it important to us? It's important that the foundation and the macro situation in China will be stabilized, will continue to be stabilized, and the companies can do whatever they do best, and then to benefit. China has been ongoing on this deleveraging process since President Xi came in, and it has been successful. According to the National Financial Work Conference that took place in July 2017, the government reiterated again, the financial sector must serve the real economy, and we should prevent systematic risk in the system. And all these are very important because, in the past, China used a lot of financial stimulus to create boom-bust cycles in the market. And underlying growth was very strong because the base was so low. But then it created a lot of volatility. Going forward, when the target for the financial sector and also the reforms are clearly stated, we have a more confidence in having more a regulated environment, but also a risk-averse environment for the whole economic to develop going forward in China. A lot of people are still worrying about the debt situation in China. I have 2 slides here to talk about a bit. On the left-hand side, it shows the total debt by sector in China, and breaking it down into household debt, non-financial corporate debt, and government debt. As you can see, a major chunk of this portion is the non-financial corporate debt. So when we look at this part, we will try to assess the balance sheet and the cash flow for a lot of the listed company. So the first thing we do is we look at 1,800 A-share listed company. These are companies that are very representative and all listed in domestic China. According to the first half results in 2017, actually, they have been constantly delivering earnings growth. The ROE for this company has increased from 11.5% to 13.5%. More interestingly is that if we are worried whether they can pay these debts to the banks, basically we look at also the interest coverage ratio. And we noticed that the interest coverage ratio has improved from 3.8 times to 6.1 times, which is the highest number since 2007. We suppose that this round of structural adjustment in the Chinese economy, we can very safely say that a lot of these companies becomes much more healthier than 5 years ago or 10 years ago. So we are not too worried about this debt situation. On the household level, again, it is well known that the household debt for these Chinese people is actually very under-leveraged. On the government level, they are also doing a lot of things to monitor the local government debt, and so we think the situation is under control. On the right-hand side, it also highlights the bar chart that is external debt for China. So you can see they are actually much lower, the lowest with 13%. I don't need to say too much on this, that we are not worried at all. So then we move on to another important country within Asia ex-Japan, which is South Korea. In a previous slide, I demonstrated to you that the earnings growth and the upgrades in Asia ex-Japan year to date, half of it is contributed by South Korea. And actually, majority of it is contributed by one company, which is the Samsung Electronics company. A lot of you might be aware of, know of this company. Actually, this company, we have a slide later on to talk about it, but then basically is enjoying a very strong DRAM cycle, driving the earnings growth in the whole South Korea region. And they are a lot of companies within South Korea also supply to the brand Samsung in terms of components, etc. So all these are benefiting from this DRAM cycle in this year. This is a slide about North Korea that Jonathan mentioned about. I highlight here that in the past history, there were like nuclear tests, but every time no major issue happened. So for this time, our stand is also again that alongside with a lot of other investors see consensus that it's not a major event that we are very concerned. And now I would like to share with you what is my major, well, I won't say major disagreement, but some sort of disagreement with Jonathan on his point that if there is a North Korea real crisis, then there will be no next review. But I would argue with him, actually, there will still be a next review for our clients, but next time we will never have a question about North Korea come up again, because definitely the US or China will take care of it. Then I would like to talk about Taiwan. Taiwan is a similar to Korea case, where it's a very tech heavy and tech leading the recovery and in terms of earnings growth. But Taiwan is a very strong supply chain for Apple products. So as you may know, Apple just launched its latest version of iPhone with various interesting upgrades. For example, wireless charging, glass casing, and also even could be better kind of facial recognition. So all these are driving the demand in these Taiwanese companies, because a lot of them not only supply to directly to Apple, but also is a component indirectly supporting to the Apple demand. Also, Taiwan is very big in supplying components and making servers or other Internet of Things. Because Korea, the difference between Taiwan and Korea is that Korea is very focused in Samsung-related products. Taiwan has a more broad-based brands and type of products, which we believe that can still have a sustainable earnings growth for this year, next year, and the year afterwards. Another thing interesting that I would like to share with you on Taiwan is that the green line highlights the valuation of the Taiwan market, which is 14.2 times. The two other lines are these Chinese companies that are listed in Asia market, and they are trading at 26.4 and 30.5 times. Why do I combine them together and show to you? because when we look at technology companies, we don't really separate them by region. We just look at how strong are they in terms of technology? What is the competitive edge? What kind of client do they have in their portfolio? What kind of margins they are earning, demonstrating how strong the technological capabilities are. Definitely Taiwan would be the top leading one if you talk about all these criteria. But compared to Chinese listed companies, especially the tech ones, basically the valuation discount is tremendous. There are many reasons behind, but we do think that the valuation gap should narrow. As you can see, with this very strong market in Taiwan for the past 2 years, basically the re-rating process is only maybe about 10% of it, but majority is due to the earnings recovery. So we are still very bullish on the Taiwan stock market. India, we have a slide here. We don't have too much in India, as you can see later in our slide, but it's worth to highlight because it's an important component for X Japan. So far, we do believe that the valuations have run ahead of the fundamentals. With the demonetization in last year and also the GST tax reform this year, it's actually dragging the growth and demand prospect so far. We definitely pay attention and look at this market a lot because compared to China, we do see a lot of opportunities for various products to penetrate into the household and consumer, but then it may still take some time. So here comes our valuation matrix, and apologies for quite busy slides here, because I would like to share with you the valuations of the various regions. I don't have slides on Indonesia and ASEAN, etc., but I'll comment a bit here. Basically, for the ASEAN countries, we like Indonesia the most because of this strong demographic, but everybody knows about it. But what's dragging them is actually the tax amnesty program that they have carried out for the last 2 years. People are very excited that they carry out this tax amnesty program and think that is on the right track. Definitely is on the right track for the developments of the whole system. However, we are seeing that this is dampening the demand growth there a bit. For Thailand, the liquidity is good. But then we are still think that the political situation there, even though priced in, is still quite unclear. And for Malaysia, I suppose it's still very challenging in terms of corporate earnings growth. Philippines is good in earnings growth delivery, but it's also trading at 18 times. Earnings growth, I believe, is still a little bit missing a lot of expectation of analysts. So all these ASEAN market, I think that going forward, India and Indonesia, we will look at them very closely and then find the right timing to maybe add on or increase exposure there. But in general, I think about 7 or 10 years, 8 years ago, we made quite a lot of money for the portfolio from the ASEAN stocks. We are getting there, but we are not yet there. So we will watch out for that. Another slide here that I would like to share with you is that we got a lot of questions saying that China has been up so much. Should we take profit? Is it too expensive? So when we look at MSCI China, year to date, approximately they are up 35%. But we can break down the component of MSCI China to 2 categories, which is the MSCI China growth stocks and the MSCI China value stocks. And it's so apparent that in the green chart, in the green bar chart, that all the growth driver for the index comes from the growth stocks, which are the internet stocks. While I understand why these internet stocks merit a higher valuations and appreciation by the investors, which I will also talk about later in the presentation, we also see there are a lot of value opportunities. It's very interesting to us. For investors like us, we always question when we whether the market is topping, is that can we find value opportunities in the market, as we are very strictly adhere to the value investing discipline. So the the answer here is very obvious. We do see a lot of opportunities still in the value arena. For example, insurance companies, banks, brokers, not so much to banks, but a little bit more in insurance and brokers. There are other companies like manufacturing companies, also it's in this MSCI China value space that we find interesting that we can share with you later. This slide is interesting is because the growth over value gap on the right-hand side is the highest historically speaking. Looking from 2005 to 2017 data, now we are seeing a 3.3 times growth versus value gap. Historically highest. While we think that there are reasons why the growth stocks trade at this valuation, we think the gap with the value stock is too big. And we are in a very good position that this gap will narrow. And we have our chance here to pick our stocks. So I will go into the next session to talk about that, how we are positioning in terms of the portfolio and how, what themes we do see that can benefit on the backdrop of the macro. So 3 very important themes we see in our portfolio. The first one is consumption upgrade, and second is the technological leaders, and the last one would be quality exporters. This slide shows the breakdown of income distribution. The highest income distribution here is 3% for people who has more than 200,000 per annum. The number here is a little bit low because they track the number that who pay tax. Then they can find that the highest 3% is people who pay who earns more than 200,000 a year. But I mean, in reality, definitely people make much more side money from other investments or other side business than in reality. But the important point is here to look at in the whole population in context. We have 1.6 billion people in China. About 35% of it now have accounts in, or maybe identification 户口 accounts in China, which they can enjoy social welfare, low education fee, etc. With the mobility of like inland city workers to coastal cities in the past 20 years, there has always been an issue that China wants to address. Is the differential of economic matrix between coastal cities and inland cities. In China, people estimate that, say, in Tianjin, which is one of the, can be considered first-tier city, versus another city which is inland called Gansu. In terms of all these financial matrix, the differential per household or per person can be 300%. In Japan, the differential is only 30%. You know, this differential creates a lot of social issues, and China's intention to narrow this gap over time. So one thing very important is to increase the people who can achieve the 户口, the identification account in these cities. A lot of these workers go from the farmland to coastal area to work, or maybe second-tier city to work. They make money, and then after 10 years, they become like 30 years old. They decide to raise a family. But the problem is that if they raise a family and have kids, the kids cannot enjoy low education fee. And I mean, in the end of the day, their income per month is not that high. So they must have to go back, to send their kids go back to their hometown to enjoy the low fee education and maybe the hospital healthcare support. So the problem creates some social situation where a lot of these parents and the kids are separated. There are many other scenarios that because of this diverse differential in the country, or maybe like even one-child policy that leads to that in the end, one child had to support two elder people when the parents retire. All these social issues are coming very imminent. It's very important to China. So urbanization is the only way to solve it, to over time time, which is to allow them to have a better upgrade in terms of income, and then they can reduce the differential between the cities. So one thing they do is talking about the land reform. In China, land reform was first officially mentioned in one of the policies about maybe 8 years ago, if I remember, 8 to 10 years ago. And then the stock market was very excited then. And then after like half a year or 1 year, everybody asked about what is the update there. There's nothing much to see. But recent 1 or 2 years, we have heard more stories. I know a few people who used to come from like maybe inner cities telling us that, you know what, the land in our hometown is becoming much more valuable. And now the government allow us with clear regulation and policies that we can sell the land to people who wants to buy it. Sometimes some big landlord would go in and buy the land maybe to convert into a resort, or maybe some like big agriculture company may buy the land and then build some farms there to be more efficient, etc. And then they can first of all liquidate the land with into some cash, and maybe they can move into the third-tier city, upgrade from fifth-tier or fourth-tier farmland cities. And then they can buy a small apartment there and grow their family, because the family can enjoy the local health support and also education system. So this is a migration process that we are seeing more meaningful conversion and a real thing happening, rather than in the past when they first announced the policies, it's not as material. So that's why we can, not only I heard a few stories from my personal circle. We also look at the property transactions in year to date. Actually, the property transaction year to date for first-tier city is very uninspiring. For first-tier property cities, year-to-date volume transaction was down 26% year-on-year. But in the third, fourth-tier cities, actually, they grow by 50% easily year-on-year. Actually, this is demonstrating this migration of people are working, and they are buying houses and apartments in these lower-tier cities. Hence, we can also study from another angle. You know, a lot of people talk about ghost town in property market, that there are so many empty houses in the lower-tier cities. So when we look at the statistic, the inventory for these lower-tier cities for property in the past used to be like about close to 3 years. The latest number is down to 14 months, and these are all due to real buying and real usage. So all these family upgrades and urbanization is helping the property cycle as well. So with this kind of urbanization increasing, actually it won't be only benefiting the property sector. It can benefit many other sectors, as you can expect it. I have a slide here on a company called Zhao Daifeng, which we have bought for the portfolios. We have bought for this portfolio for a few years. It is one of the leading brands in Hong Kong with history, with the operational history of 50 years. It's a household brand name. They have expanded into China many years ago, and now their earnings from China market is about 70%, with 30% in Hong Kong. And we bought this about 2 years ago, the first time, because it was a very high caliber stock, but suffering from one of a policy change in Hong Kong. So they have a lot of stores in Hong Kong that sells jewelry. And Hong Kong retail, as you may also know, enjoyed a lot of big boost when PRC government saying that they allow the tourists to come into Hong Kong more freely a few years ago. But then this policy was suddenly reversed a few years ago because of capital control, and then Hong Kong cannot handle so many tourists coming in one go. This company suffered because their sales growth is much less than they previously expected. And also the shops that they rented in Hong Kong are all locked in a very high rent. So they need 2 years to adjust. And we bought this company about 2 years ago because we know that we covered this company since it was listed in maybe more than 5 years ago in Hong Kong. We also cover their peers, all the major peers that are listed in Hong Kong and China. And we understand that this is a major beneficiary because people are ignoring that they have been streamlining their stores, streamlining their costs. And at the same time, we also noticed that the recovery in Chinese jewelry sales in this data. So all these play off very well. We bought the stock at about 4 something. Now it's about $8. So these is only one of the example that consumption upgrade will benefit in stock once they reset from the previous 5 years of Chinese adjustment. And this is this is again not only the only example. I don't have slides here, but there are other examples that I talk to investors as. For example, there is a Asia-listed spirits company. These are the leading brands in China called Maotai and Wuliangye. Basically, these are the top-tier companies that used to sell like 40 times PE easily, where we don't buy them because they are so expensive, they are so well known, but very good business. So in the past few years, we have the opportunities to buy into these companies. And because when there was anti-corruption campaign, 30% of their sales were gone because the background is that these spirit demand in China, 30% used to go to entertainment or maybe business dinners between government and also business companies. When the President Xi came into power and he announced this anti-corruption campaign, all the people in Beijing or other cities actually they don't dare to go to these kind of banquets anymore. And the spirits companies suffer a huge problem because they need to clean their inventory in the system because they didn't expect this. And they also have to realign their marketing channels to cater the real demand of the broad market. So after 3 years' time, they are successfully done so. And they are now we are still holding these stocks. They are trading at about 21 times PE, still very reasonable because they are the leading brands. Again, we are value investors, but in China, we think it's a very historic time for us to identify names that will be in the US, Coca-Cola or the leading Procter & Gamble, etc. This is the time that we believe that is an opportunity for us to gather these kind of names in China. So that's why we still hold on to them. And going forward, they are still gaining market share from local brands. I remember I mentioned about the consumption upgrades, because when in the past, a lot of these consumers may purchase local or maybe very small brand spirits. But because of these leading brands, national leading brands, they are definitely better in terms of quality, but are slightly more expensive. But now they can afford to do so, so they upgrade themselves. Another example would be sportswear. In the past, maybe they buy some local brands for sportswear, like running shoes or exercise clothes. But then later they upgrade to like Nike, Adidas. So that's why you see Nike and Adidas when they announce their results. The major spotlight is still also on the China growth. So here, I also use Zhou Daifeng to highlight the case. I have put a few global companies like Hermes, Prada, LV. When people look at these companies, when they announce results, like I mentioned, like same for the Adidas and Nike, they would study how strong is their China-related growth. But we have Zhou Daifeng here. 70 to 80% of the earnings growth comes from China, whereas they maybe usually have 30% come from China, driving the whole company growth. But they are trading at a discount to valuation. I mean, so it's a little bit illogical that why these companies are trading at better growth rate, delivering better growth rate, but at a less recognized and as a discount on valuations. This is only one of the case, and there are many others examples again that I can talk a little bit in the next segment, which is related to the technology leaders. When consumption wants to have upgrade, we need that technology also upgrade to help them. There are a few areas that benefits. For example, in internet traffic, this bar chart shows the increasing growth rates in internet traffic. Here, it shows that the online retail sales in China is growing 30% per annum. It's the same everywhere globally. Online sales is taking market share over offline. All the offline companies that used to be the darling of investors, for example, department stores and other offline retail chains, are actually suffering from sales decline because it's a change in habits for consumers. And in order to benefit from the consumption upgrade and consumption growth in China, we do have to identify the right internet stocks that we want to purchase and have exposure in. Here is another example on one of our top holding called Lagen. Lagen is a company who makes camera modules and also camera lenses. Their most well-known client is Apple because that is the highest tech and highest technology requirement brand globally. And they supply to them, even to this date, 100% to some of the high-end model. So we are seeing that consumers are getting more demanding in terms of the quality of the cameras. So in the past, we only have one camera. Now they want dual camera. People are also talking about going forward, maybe for the laptops, they also want to have dual cameras. So all these upgrades are driving demand for this company. And this company has the technology to deliver because for dual camera, there is definitely some specification technologically create some barrier to entry for some low-end makers. Again, here is a slide about the DRAM. DRAM is one of the major products of Samsung Electronics. So if you look at 2017, on average, all the electronic-related products, such as like mobile phones, servers, or even to a certain extent TVs, are generating strong demand growth here that drives the demand for DRAM. And DRAM used to be a very cyclical industry and it used to be a very oversupplied industry. And oversupply situation created a situation that some of the participants there are making huge losses. So in the past few years, there were a lot of some players exited the market. And hence, we can see a shortage and a very tight situation this year. And hence, Samsung Electronics is enjoying a very strong run in terms of earnings growth. We have an individual slide here, Lagen, which actually is the same company that I mentioned earlier, talking about the dual camera module. I want to highlight here to show how we evaluate the company is strong in technology. You know, Apple being such a powerful brand, he demands the lowest cost from his manufacturer or vendors. But this company can consistently generate 60%, 70% gross margin on average. It means that they have bargaining power on that component over Apple. So technology is very niche, and also we're putting a lot of analysis to understand whether this is going to be a sustainable or not sustainable for this company, at least in the next 2-3 years. Samsung Electronics has a slide here because it's also a heavyweight holding in our Premium Asia Fund. As you can see, about 30% of their sales comes from the semiconductor DRAM. But in fact, the DRAM contributes about half of their earnings. Handset, even though it contributes about 41% of their sales, actually only contributes about 20% of their earnings. After a very strong run in 2017 due to the semiconductor cycle, as I explained, next year, the earnings driver for Samsung would be the display panel. They are the key OLED, they are the only OLED supplier to Apple. And with this new product coming in to the market from Apple just announced, we expect that Samsung Electronics can still deliver a healthy 10 to 15% growth, or if the DRAM cycle is stronger than expected, 15 to 20% earnings growth in 2018. And this stock is only trading at 8 times PE, below 8 times PE, which is very low in terms of the context that this is one of the global leading tech companies. I think the reason is because Korea has been suffering some issues in terms of investors' perception. But they have been on the right track improving in terms of corporate governance by doing more share buybacks, paying more cash dividends, and be more transparent in talking about the results to the in terms of the broad community, investment communities. So in the example that we saw in Taiwan, which started 10 years ago, in paying more dividends, require the listed company to announce quarterly results, all these would improve the valuation for the broad market. This is another company in Korea that we also invest for our clients in Premium Asia Fund. This is a newly listed company in Korea. Its business is that it's the #1 manufacturer for inspection machine for the flat panel display. So with the proliferation of flat panel display in all the market, this company is actually benefiting a lot. As you can see, the margins are improving from 2014 to 2017 from 14% to 45%. They have this proprietary in-house developed equipment solution that can inspect this flat panel in a more efficient way. And as the revenue ramp up, as they gain more clients, and as they gain market share in the industry, they can enjoy a better margin. This company still has a very low number of employees. They only have less than 50 people. They are all tech people they are very strong in tech. So we like this company too. This company is an IPO this year, as I mentioned, but because actually it's a very hot IPO. But given, Premium Asia Fund is enjoying on the backdrop that Value Partners has about $3.5 billion managed in the Asia ex-Japan in our other products. So Premium Asia Fund can also enjoy this support because we are very important to our brokers. So whenever they have a very good IPO to launch, we have the bargaining power to get more shares for our clients to benefit them. Alibaba. I put Alibaba here because I also mentioned about the online retail sales. Remember there was a slide on MSCI growth and MSCI value. For us, as I mentioned, internet stock is imminent for us to put in the portfolio because it's a change of habits and living style, and this is one important way for us to benefit for our clients. But how do we handle the valuations aspect? What we do is that we try to be much more selective in terms of valuation. Tencent is still one of our stocks, but a few months ago, we have already reduced slightly our exposure to from Tencent to Alibaba. And with hindsight, this has been a very successful switch. Alibaba has outperformed Tencent in terms of share price performance in the past few months. The reason why we did the switch is that even though Tencent is focusing more on gaming and maybe the WeChat, something is similar to WhatsApp ecosystem, Alibaba is more 80% of the earnings and revenue stream come from e-commerce. Both internet related, but a little bit different segment, but both are delivering very strong growth. They each are delivering expected 25 to 30% growth per annum. But we noticed that Alibaba is trading at about 30% discount in valuation when we decide to do the switch. And the reasons behind this valuation discount from our analysis is that Tencent has more than 10 years of listing history, and they have proven themselves many times to be a very well-loved stocks by the investors. So investors are willing to pay them a premium. Whereas Alibaba used to list in Hong Kong, but they privatized and they relist in the US just 2-3 years ago. So investors in general still want to build up their learning curve on this company, and they will rather give a more conservative valuation. But when they realize, when they announce one set of results, second set of results and ongoing, they realize that this company is also very serious. So that's why we are seeing a re-rating trend. So this is also one of our top holding in the portfolio now. So the last major theme in our portfolio is that the quality exporters. In the maybe 10 plus years ago, manufacturers in China are very important. They export, they make many things and export many products and export to globally. But then there were times that they also suffer because of labor cost increase in China. During the very high growth phase of China economic growth, the labor cost in China grew 20%. Labor cost, the salary grew 20% per annum. Also, renminbi appreciation of like 4 to 6% per annum is also hurting the cost of a lot of these manufacturers. So these manufacturers took like maybe the past 5+ years to adjust. A lot of them actually went out of business, but those who remained become the world leaders. There are like about 10 names here. All the listed names that one way or the other we have at the right price we have invested or currently holding in this company. For example, VTech, which is now on the number 4 of this bar chart, is actually one of our top 5 holdings in the both funds. This company, VTech, is a company that we know them for like more than 20 years. Even before I joined Value Partners, we also invested them. I myself also invested them for 2 times, 3 times in the past history. It has 3 lines of businesses. One is they make electronic learning products under the brand for VTech, and also they acquired Leapfrog about 18 months ago. The target audience is age 2 to 7. And they also have manufacturing for residential cordless phone and commercial phones for like businesses. For example, Frankfurt Airport recently also gave them a major contract to one of the units. And then the last division is the contract manufacturing business. Contract manufacturing business in China has two types. One type is those who cater to Apple computer that are very consumer product driven, big volume, and then the client is very powerful. They can demand you to lower your margins, lower your price 15% every year. But for them, the contract manufacturing, they focus on the niche market, which is for like musical and medical equipment. These are more like smaller volume, but more customization within the product. So then they can earn a better margin. And because of customization, these customers are more stick to these to VTech. So not a lot of broker cover this company in Hong Kong, and we realized that actually a lot of them got their earnings forecast wrong. They will announce results again in November, and we are also hopeful that actually they have very good sets of results. We have these conclusions not because we have any information that we should not get, but because we understand the business. We cross-check the business. We understand that a lot of investors or maybe analysts miss the point that they don't like the residential phone business because it's declining for sure, because a lot of people don't buy residential phone, they use the mobile phone. But they ignore the fact that the commercial phone business is actually taking off. And the commercial phone business is the average selling price is actually 2 times, 3 times, or even 4 times per residential phone. And the margins there are even higher. So the product mix improvement actually is very favorable to drive like the earnings growth of these companies. So a lot of these companies have evolved over the past 10 years and become very, very interesting and very leading position, gaining market share against their peers. Tektronix is also one of our top 10 holdings, which is I would categorize as a quality exporter. It owns a few brands, namely Ryobi and Milwaukee. I believe Ryobi and Milwaukee are also sold in Australia. They are cordless power tools, supplying to the DIY market and also the industrial professional market for construction workers. They have been gaining market share against Black & Decker for the past 5 years. So these companies are is very well run, and they have brands. They have very clear strategies to how to penetrate the various markets. So we believe that these are winners that evolved from the past 10 years of adjustment in the universe. So these are some of the investment themes that I would like to share with you all. And the next few slides would be a quick review on the portfolio in terms of performance and our top holdings. I'll start with Premium China Fund. As highlighted here, the Premium China Fund outperforms the MSCI China Free Index and also with a lower volatility. We, as some of you may also know, that we are absolute return fund, but a lot of the clients will also judge us against the index, so we put here for you as reference. These are the exposures in terms of sector and geographical exposure. The cash level here is a bit high because it's at end of August, and we were doing normal buy sells. But actually, usually throughout this year, our cash level is about 2 to 3%. Actually, the latest cash level for our Premium China Fund now is 1%. This is our top 10 holdings. So Alibaba, I mentioned in our previous slide. Tencent, we still like it a lot because despite the valuation come up, we did some switching there, but the business momentum is still very strong. And there's one new category that is a lot of domestic Chinese money is coming to Hong Kong, which we call the southbound flow. These are money that legally get quota in China, and they can get out of China and invest. The first place they like to come is Hong Kong, and they like to invest into Tencent because they use WeChat every day. So they just ignore the valuations and just buy. So we'll evaluate this situation for Tencent, but definitely we still like the stock a lot. VTech is the residential phone, commercial phones story that I mentioned. Ping An Insurance is tied to the consumption upgrade in China that currently we see that the GDP per capita in China is at a stage which is similar to the historical number in US, where the demand for these simple life insurance products take off, and Ping An is here to position to benefit. Wuliangye Yibing is the company that makes the spirits in China. Number two brands in China that we believe also is related to the consumption upgrade story. China Overseas Land and Investment, and China Vanke, which is the name after the next one, are two property companies that we believe will also benefit in the next 6 months. Because in the past 8 months or so, China is seeing very strong growth in property sales in the 4th and 3rd tier cities. Whereas the 1st tier city, due to some tightening measures in China, they are lagging. But we expect these numbers will reverse because the top-tier city data set now, we have a very low base. And these companies are trading at historical low valuations. So it's becoming a very interesting value opportunities. So we did this switching into it recently. Since China is one of a major laggard in the gaming space in China, I'm sure you may be also familiar with the gaming situation. Basically, this company now is trading with 5% dividend yield and 17 times PE, whereas their major peer is trading at maybe like 40% premium to the valuation. So this is a value case that we want to put, the reason behind why we buy it. So Tektronix is the cordless power tools that I mentioned. Here is a snapshot of the performance of Premium Asia Fund. Since launch, again, we have outperformed the index with an annualized return of 11.7%. Again, here we are seeing, we went through some slides that the whole Asia ex-Japan macro. Today I just saw one of the report from Merrill Lynch, I believe. They are calling that a lot of these emerging market countries are just beginning to recover in terms of earnings. And in the past history, usually this cycle can last for 42 months. And then usually this kind of 42 months can deliver a return for investors in these markets of about more than 200%. So now, it's not totally relevant, but for emerging market, it's up only 60%. So I think the whole case is that the macro situation becomes stabilized, and we are playing into the recovery theme. And the ASEAN hasn't performed yet. So we are still seeing that there are reasons that we can derive similar returns. This is the exposure by sector and by geographic for Premium Asia Fund. Again, the cash level here is due to some buy-sell ideas during that point of time, but now it's actually about 2% cash level. So here ends, this is the top 10 of our Premium Asia Fund. Maybe I can go through, actually for the China portion, it's quite similar to the Premium China Fund. But for the non-China portion, we still like Samsung Electronics, TSMC, and Uni-President, which is a Taiwanese company with 80% of their sales and earnings come from food and beverage businesses in Taiwan, and they are the operator for 7-Eleven in Taiwan. CICC here, the China International Capital Corp, is also in the Premium China Fund, but not in the top 10 due to position sizing. But this company is actually one of the major brokers that can benefit from the flow from China to Hong Kong, and also the investors' flow from foreign countries to Hong Kong. So that's why it's also in the top 10. So back to the 3 questions that Jonathan posed earlier. What are the inefficiencies in the market in which we operate? So we still believe that Asia ex-Japan is a very under-researched market and undercovered. So that's why our team of 60+ analysts can do our bottom-up research. Together with a more stable macroeconomic outlook, we can dig out the companies that are more stronger versus the weaker players. Whereas in the past few years, I have to admit that because of the volatility of the macro situations, sometimes some of these good companies also suffer sell down or sell off irrationally. And then we also have to suffer in the meantime. But going forward, a stable macro situation is good for us. And also Chinese equities remain to be very retail-oriented. Actually, not only China, Taiwan and Korea also. Retail investors are still known to be more short-term, momentum-driven, and we can exploit that because if some investors do not like a stock because of the quarterly earnings disappointed, but we know that over time, the full year or the long-term, mid-term outlook is very solid, we can take the opportunity to accumulate stocks for our investors. So how do we process how does our process exploit these inefficiencies? Yeah, like Jonathan mentioned, we continue to carry 2,500 companies visits and site visits locally. We have offices in Shanghai since 2009. We have offices in Singapore since 5 years ago. For Korean market, we have 2 Korean-speaking analysts in-house. For Taiwan, we have 2 person in-house in Hong Kong, but fly to Taiwan weekly. And in the Singapore office, we have 5 investment professionals who come from various countries in ASEAN who has experience in the ASEAN universe. So we are still at a very early stage because we are still emerging markets, and it will take some time. And then we believe that this value add in the market still exists. So here ends out my part of the presentation, and if you have any questions, please bring it up after. And now I pass it back to Jonathan. Thank you.
Thanks very much, Renee. So what? The question that you ask at the end of every presentation that you finish hearing. Some things that you can consider doing when you get back to the office. You consider reviewing your international exposure to explore what the earnings growth drivers are for the companies or the funds that you hold, and whether or not they are sustainable going forward, and whether or not their business models are being disrupted. Number 2, we've provided evidence to you to show that value investing right now is in a prime position to provide an optimal risk return profile for your clients going forward. Number 3, given the lower political risk in China itself, coupled with attractive valuations, and yes, attractive valuations has been a consistent theme for many, many years now, is it time to review your allocations for your clients in the world's 2nd largest equity market? And fourthly, technology appears to be the centerpiece of most equity market portfolios, and which geographical exposures provide you with a high growth potential. Now, at the brackets of the packs in which you see on each of your tables has been laid out, there's an article at the back that I've published for Money Management. So I'm the China specialist now that publishes articles for Money Management on a quarterly basis. And the last one I wrote was on MSCI adding China A shares to their benchmark indices and what the impact of that is going forward. This is something that I'm happy for you to share with your clients.